Hello and welcome to the CNBC TV18's Mumbai studio. I'm Sonal Bhutra and you're watching MF Corner. On the show today, we are going to put spotlight on the idea or the importance of having a time frame for your mutual fund investments. Generally, it is said having a longer time frame can help you participate in different market cycles, but a shorter time also can help you give good returns if chosen judiciously. To discuss in detail about the importance of having time frame in your investments, let's welcome Kshitij Mahajan, the co-founder at Complete Circle Consultants, and Niranjan Avasthi, SVP and Head, Product Marketing and Digital at Edelweiss Mutual Fund on the show. Gentlemen, good afternoon. Thank you so much for joining us today. Niranjan, let me come to you first up. How important is it to have a time frame when you're investing in a mutual fund?
Thank you for having me. So broadly, when it comes to investing, not only mutual funds, any asset class, if you're investing, it is very important to have a time frame in mind. Let me give you an example of FD and real estate. For example, you want to invest for 1 year, and if you select a 3-year FD instead of 1 year, while redeeming after or while taking out money after 1 year, you'll have to pay a penalty, and your interest or whatever interest you earn will also be lower. Similarly, if you're investing in a real estate, you know that you need to invest for maybe 1 year, 2 years, or 3 years, and it should be in years and not in months because just selling real estate would take years. So any asset class, be it FD, be it gold, real estate, or equities, needs to have that matching of your investment horizon and the asset class return potential and the risk. Similarly, when you are investing in mutual fund, it is very important to match your investment horizon. And within mutual fund also, if it is equity, it needs to be long term. If it is debt, it can be short term. And likewise, it should basically match your investment horizon and the underlying risk of all these asset class within mutual fund as well.
Okay, take that point. So goal is one thing, but of course, time frame for how long you have to keep that mutual fund investment is important as well. Kshitij, come in on this because people do sometimes not have a time frame and they say, okay, we'll invest and then we'll see. Is that the right approach?
So, hi everyone. My submission here is that if you are investing, let's say somebody started investing a year back and they must have seen a remarkable journey in the equity market in last 1 year. But if you book some profits and if there is no goal which is attached to your investment, then you end up not enjoying the fruit of compounding. Eventually, if there is a directionless move, let's say you move out of your home for a car drive and you don't have a plan to reach anywhere, you'll come back in some time. But if there is a destination which you have aligned to your investment, it will end up making you or giving you that compounding benefit. And you see, that's what work in a long term. So let's say whatever you want to invest, how much amount you want to invest, just align it with a goal. A goal can be a short-term goal, let's say a 3-year goal where you can have a fixed income or a multi-asset or balanced advantage fund, or a 5-year goal or 7-year goal or 10-year goal. Or let's say a goal can be aligned with your personal goals of buying a car, foreign vacation, or it can be marriage, children's education, retirement. It can be any goal. But when you align a goal, then you end up sticking with that goal and you will end up making the best of whatever you're investing into rather than just booking some profit because you see things doubling or tripling in your portfolio. But just for information, there are more than 11 mutual funds who have actually given 100 times return. Their NAV is more than 1,000. Some few funds are having 200, 250 times return also. But for that, you have to stay in that fund for 18, 20 years. That's what I'm talking about. So I'm saying, rather than just looking at that time frame because you are getting a multiple of your investment, just align it with a goal which you want to do. Because this will help you in planning things better and enjoying the fruit of compounding in a better way.
Totally take that point. You need to know where you're going and how much time you want to be there or, take time to travel till that place. Niranjan, usually people say equity investments are for long term. But what does long term exactly mean in this case?
Right. Let me start with an analogy. So imagine you're traveling by a flight and inherently flying through a flight is quite risky because if anything happens midair, you're doomed. And if you're traveling by road, the risks are quite lower because if anything happens to your car, you can just go on the side of the road, repair it and move on. But when we look at the data, your chances of dying in a a flight crash is just 1 in 11 million, which is quite low, versus in a road accident, which is 1 in maybe 1 million. Uh, why it is so? Because the safety standards that are there in a flight which you take, you need to put your seat belts, the multiple checks of the aircraft which is done before every flight reduces the risk. I think so. Same goes with equity investing space, specifically. The risk inherently is always there. When people say there is no risk in equity in the long run, it is wrong, because even if you are invested for 10 years, that last 1 month you can see a drawdown of 10, 20% or 30%. But what happens is, the safety belt in equity is time. What happens is, if you invest for longer period of time, you compound and make a lot of returns, so that even at the end of period, if there is a month of 10% or 20% drawdown, you still have enough return which are positive. And that is seen in the data as well. If you are invested for more than 10 years, the risk of you making negative returns is zero. Whereas if you're investing for 1 year, the risk of making negative returns or less than zero is 47%, 47% of the time. So time is that seatbelt when it comes to equity investing, because it allows compounding. It allows you to stay invested for long term, and tide over all these volatile markets. So markets will remain volatile. Markets don't know whether you are invested for 5 years or 10 years. It will stay volatile even after 10 years. But by 10 years, your probability of making money and not losing out, increases. Second is, with time also ensures that you beat inflation, because inherently you invest in equities to beat inflation and make real returns. So over a longer period of time, say 7 years or 10 years, your probability of making 10-year returns, looking at the past data, is more than 85%, which is great. So, time is basically that safety belt which makes this flight of equity investing quite safe.
Okay, and you have shared a very helpful table with us as well, which my team is flashing on the screen right now. Makes sense. Let me come to you, Kshitij, because we're talking about time frame in a particular category. Does your time frame also change when you're investing in some other category, say debt funds? How long should one stay invested in debt funds?
So fixed income or debt funds, they're a part of asset allocation. So we have gold, we have real estate, and we have fixed income, equity. Now, there are other asset classes also, but key asset classes are this. I know whenever we talk about asset class, people don't even take real estate. They take other parts as asset class, because real estate too, people normally they have. So I'm saying fixed income, yes, they have become a little less lucrative after the new tax regime last year. But at the same time, what happened is, like, it has to be a part of your asset allocation in a big way. And you should align your fixed income allocation as per the underlying portfolio or maturity of the underlying portfolio of fixed income, because otherwise you'll have market risk in fixed income also. So let's say if you are giving some fixed allocation for 5 years, then you should have an underlying portfolio whose maturity is in 5 years, so that there will be no market risk when your money is maturing. So depending on, so yes, we always say more than 5 years you can look at balance funds or let's say equity fund, but still you want to go with the fixed income side, then align your portfolio maturity with your money maturity when you require money. That is something which one has to do. It can be done tactical also. Sometimes, we say that sectoral bets in equity. Similarly, on the fixed income side also, when you are on the peak of interest rate cycle, you can actually do some tactical allocation towards long duration portfolios, where you will get a better benefit when rate cuts will happen and capital gain will add on to your overall coupon also. So yes, time frame changes with other asset classes also, depending on when you need the proceeds of the money which you are investing into. At the same time, for gold, like something like gold, I think gold is a good hedge. It should be in the portfolio 5 to 7% around in anyone's portfolio, and it should be kept for that long. So there's no time frame I will decide on the gold side, but somebody who actually needs for some purpose, then you can actually look at 7-8 years. You can buy a sovereign gold bond funds where you can get a tax-free return after 7 years. So I think that is one thing which one can look at. Otherwise, this is how one can treat fixed income and gold.
Okay, interesting. So there is different time frame for every other category that you're looking at. Niranjan, come in on this because there's so many subcategories in debt funds. It can get confusing at times, right? The duration differs. How can an investor look at timing their debt fund investments?
Right. So one very basic thing one can see or one can do while investing in debt is matching their investment horizon with their with the duration, that is modified duration of the debt fund. Because technically, what happens if you give time in that bucket of the debt fund, your risk reduces. So, for example, if you want to invest for maybe less than a year, maybe a liquid fund, ultra short term fund would be a better option. If you're looking for somewhere between 1 to 3 years, maybe a low duration fund or a money market fund having or investing in 1 year or 2 year bonds could be a good option. And only if you are investing beyond 3 years, you can look at categories where the duration of bonds is higher, like short term fund, short term duration fund, medium term duration fund, and maybe corporate bond fund. So aligning your investment horizon with the duration of the debt fund is one of the basic things that you can do to ensure that there is no mismatch between the risk that the fund has and the risk that you want to take in that fund.
Okay, all right. Take that point. While we're talking about a lot of considerations for timing your investment, how important are tax considerations when it comes to determining one's holding period? Or one should just look at returns over a period of time? Kshitij, comment on this?
Yeah. So I think when it comes to different asset classes, tax is the most important part, which adds on to your overall kitty of returns if you are in a better, tax saving instrument. So that, as I said in my previous answer, that on fixed income side, that benefit has been taken, which used to be there as long-term capital gain. But yes, there are various instruments on multi-asset side that you can play and still get the benefit. At the same time, the tax is on the gain only. So I think one thing when you are investing and doing your asset allocation on the equity side, whatever tax you are paying, it's on the gain side only. And you can actually look at playing it a little better by taking the benefit of 1 lakh capital gain, which is exempted on the yearly side. At the same time, whenever you want to redeem your things, and if you have some capital loss, which is in some other asset class which you have, you can take the benefit of offsetting that with your gain also. So, one can look at playing or let's say participating in a portfolio in a better way rather than just switching between the portfolios, because the cost of switching is very high when you have to pay taxes also. So one has to look at that part also when you are aligning your portfolio in lieu of the taxation part, which you have to pay. So yes, asset allocation is important, but doing through a better way in terms of there are various funds where still there is a benefit of fixed income taxation is little more lucrative, whether it's just paying a full tax on the fixed income side. On the equity side, yes, you can take the benefit of, as I said, the gain which is there on a yearly basis. At the same time, any loss which is there, you can offset that also.
Okay, all right. We take that point. It's a very interesting conversation, but we have to get into a quick commercial break. On the other side, we'll continue this discussion and understand more aspects when it comes to timing your investments in the mutual fund segment. Welcome back. You're still tuned into MF Corner. We have with us Kshitij Mahajan and Niranjan Avasthi. We are discussing everything about a time frame in your investments and when you should enter or exit a particular investment or mutual fund category. Niranjan, let me come to you because we talk about when to invest. But when should one take out money from one fund to put it somewhere else or exit something completely?
Right. So there are multiple, instances. One is when you are invested in a fund and it is underperforming. You should give at least 2 to 3 years even for an underperforming fund, because a lot of funds, or rather most of the funds, goes through their own performance cycles. So before redeeming an underperforming fund, give it time. Also understand why it is underperforming. Take help of your MFD. Go to, talk to the mutual fund house if they have any communication around it. Understand it. And only then, once you are fully convinced that I need to exit and then reinvest in an appropriate, fund. Most of the time, people go wrong here because they exit an underperforming fund and enter into the best performing fund. And next year, most probably the best performing fund comes down because the law of averages plays out, and then the cycle continues. So that is not the right way. Give it time. Many funds that are performing, the best performing fund today, also would have had that time when they would have underperformed. So give that time. So that is one where you weed out the underperforming and get into a good decent fund. Second is when your asset allocation gets skewed in a time like this when equity is performing very well. Most often than not, your equity allocation naturally builds up more and goes above your risk tolerance level. That is where maybe you can book profits, get into debt or any other class if you want to reduce that risk. uh, Third is when you are coming closer to your goals. Most of the time, if it's a long-term goal, we end up investing in equity, which is the right thing. But if you are coming closer to your goal, maybe 18 months or 12 months, or even 2 years before, and markets are doing well, start exiting gradually. And that is the time when you can start exiting your fund. And lastly, when you need money, mutual funds are the most liquid instrument. You can just go and redeem, but make sure you need it for building an other asset class. Of course, there could be emergencies and all, but these are the four instances where you can redeem. And also the way you redeem, whether it is gradual, whether it is one shot, is also important.
Okay, those are the three instances which you should keep in mind when you want to exit a particular fund or invest, take out that money and invest somewhere else. Let me come to you, Kshitij, because while we are talking about exiting a fund, there's an exit load as well. If you exit an investment early, does the exit load change? How does it matter in terms of costs there?
You see that most of the funds where you have exit load is for 1 year, and 10% of the units are exempted from exit load, because that's a leeway has been given by SEBI and MFI that most of the funds where you have exit load of 1% for 1 year, 10% there will be no exit load if you need fund before 1 year. So one is, if you have a gain, you end up paying exit load as well as capital gain also, which is little higher. So exit load as a component is there, but you end up paying 15% capital gain, which is 10% if you exit after 1 year. Now, most of the funds are taking a route where you have index and ETFs, and many of the active funds also, there is no exit load or lesser exit load of 90 days or 30 months, which you will see coming in most of the funds going further also. But yes, as a house, why the exit load is there, just to have that patience level on client side, so that they should not be in any hurry to exit the funds. So that is something to just to have that discipline from the investor side also. But yes, there will be no change if you're exiting after 1 year. There will be no exit load. There is no exit load across any of the schemes right now as we speak on the equity side. On the fixed income side, depending on various schemes, there are certain schemes where you have exit load of 2 or 3 years also, and that has been kept looking at some changes in the overall scheme, or some liquidity which has been created because of the recovery of some funds. So that has been done. But yes, only all the equity funds have exit load. There is no exit load after 1 year, and yes, we should take into account capital gain part also.
Okay, there's a lot of things to take into account, and that's why we have experts like you on the show. Niranjan, if you can quickly tell us, tax loss harvesting, is that a good strategy to lower taxes on mutual fund redemptions? What is the impact here?
So, tax loss harvesting in nutshell is basically, booking losses in funds or investments that are in losses today, and, setting off that loss against a profit made by some other asset class or some other mutual funds, which is allowed by, as per the tax laws. So a short-term loss can be set off against a short-term gain or a long-term gain. At the same time, a long-term loss can be set off against only a long-term gain. So this needs to be kept in mind. So it's a good strategy, provided that you reinvest that money at the right time, at the right moment, and don't end up keeping that in your bank account or just lying around. So tax loss harvesting is basically redeeming a fund that is not performing, booking that loss, and if you have any other investments in that year which are in profit, you can book profit in those funds as well and set it off. Most important thing is, a lot of people, while they redeem from loss making investments, they don't reinvest that, which is a big loss, because if it is an equity asset class, equity may run up immediately and you may lose out on that reversal in the cycle. So having a reinvestment plan is most important when you plan to do a loss harvesting. Same way, on the positive side, as Kshitij was mentioning, that 1 lakh in a year is, you can book profits and you don't need to pay tax if it's a long-term capital gain. So tax harvesting is also the other way around, where you can book profit up to 1 lakh in a year and then reinvest that money so that your 1 lakh, which is there, it's completely tax-free in that particular year.
Makes sense. Makes sense. Gentlemen, it's been a pleasure having the two of you on the show today, because a lot of people invest with goals in their mind, but maybe they don't understand that it needs a time period in terms of your goals as well. Thank you so much for joining us today.
Thank you.
Thank you.
Okay, all right. With that, let's move on and talk about an important news piece. Sources are telling CNBC TV18 that AMFI has written to market regulator SEBI seeking relaxation in the new KYC norms for investors that kicked in from April 1. So we'll talk about that in greater detail, because it has been causing a lot of issues for the investors, and there are some relaxations that AMFI has asked for. There are SIPs which are not going through. There are issues with redemptions, and there are also issues for new investors and NRI investors as well. So this is something that we have written to the AMFI about as well, and we are awaiting their response. Okay, all right. With that, we will wrap on this edition of MF Corner today. But stay tuned for Closing Bell to take you through the last hour of trade.